Happy Friday, folks. Again, it's going to be, I'm probably somewhere between 5 and 10 minutes of a lesson today. While you're here, please like and subscribe. Ganja keeps reminding me to say all that because if you say it at the end, there's that whole hockey stick thing, and there's probably fewer people at the end except for the real fans. I appreciate you all very much, whether you're here for 5 minutes or whether you're here for the whole episode. I know there's a lot of competition for stuff out there. I think this channel is kind of unique. And so today, I'd like to address some comments that I've gotten for folks who are probably working by themselves and they're trying to make it as short-term day trading, swing trading. They don't have a strategy yet, so they feel like they're all over the place and they're kind of chasing their tail. That leads them to feel foolish, even though that's part of it, because I don't know any type of a trader on any asset class who trades any particular time frame that doesn't somehow feel foolish when they look back and say, geez, that's kind of what I used to do. It's kind of cringeworthy. But that's life. That's what we have to deal with in our trading evolution. So when I talk about if day trading isn't working for you, what data would you look at to see or validate that there are other strategies that are at work that make money when you compare to the time, money, and effort that you're putting into your craft right now, and you want to see how the other half lives? Because ultimately, you can't necessarily go on opinions, right? There has to be empirical data that you can look at to see. So I did a simple test. I've talked about it a while ago. I don't know if some of the newer listeners might have heard it or not. But the strategy would be one in which you can make money in a way that's very, very different from the way you're doing it now, or trying to do short-term intraday stuff and extend your holding periods in ways that emotionally might horrify you or scare you or give you a lot of insecurity, but might also help you understand how risk works and how you get paid in the marketplace. At the same time, perhaps cut down your costs in terms of executions and commissions, and then also cut down your need for being in front of the screen all day. Now, some of you might like to be in front of the screen because that's what you feel like traders should be doing. I was never one to spend an inordinate amount of time at the screen during the day. Most of the time, I was using computers and have used them for research before, trading, usually at night. For my temperament and personality, I like to come into the day with a strategy. I also live in Los Angeles, so it's hard to get up at 4 and start thinking about heavy concepts and getting prepared for the day that way. If you're in New York or you're in Europe and you're trading the U.S. markets, you've got all day to get your shit together, right? So it's a different sense of urgency. Now, admittedly, if I was in New York or Chicago, I might consider it. But the truth is, even when I was living in Manhattan, which I loved, I still identify with being a New Yorker. That's my pronoun, Manhattanite. I still did all my preparation the night before. And it would drive girlfriends and everyone crazy because it'd be like, can't you just let go? And the answer was, yes, of course I can let go. And we had fun and did casual things and go on dates and see museums, hang out in Central Park. But ultimately, I found that there was a direct link between my performance and the amount of preparation. Then, like anything in life, you get better and you can become more efficient at your preparation, but it has to be done nonetheless. I also know from my temperament and my personality that if I had to figure things out on the fly, which is how I would say it to myself, trying to do it in the morning, I would liken it to like a big meeting or an appointment that you have maybe for a job, or you want to meet an allocator. I would never go, if in that meeting was, say, 10 o'clock Eastern time, I wouldn't be up at 6 or 7 doing my preparation. I would feel like, man, I'm going to screw this up. I'm not prepared at that point in time. So that's my mindset when I think about trading for the opening bell. Not the pre-market stuff, but the straightforward 9:30 a.m. Eastern time opening bell. The preparation would start days before, including wardrobe. Right? What documentation, what might I anticipate that they would ask me for that I could bring as like evidence? What are some of the key points that I want to get across if that person interviewing me doesn't evoke it from our conversation? What things are on my resume that might be missing? Where are there some holes in my resume that might not make me the ideal bullseye candidate, but close enough where I might, in having them meet me in person, I can kick ass and consider myself as a finalist in their decision-making process, right? So that's kind of how I liken the idea of having to find a catalyst for trades the morning of versus kind of knowing what I want to do sometimes days before, certainly no later than the night before. Different strokes for different folks. It's not for me to say what's best for you. I'm just explaining where I'm coming from. It's not something I take lightly. There's a lot of thought that goes into it, right? But also now I've got 30-something years of track record where I know that that works for me as a process. So now the goal is to refine that process, right? Now, that's not to say that there are days where things have taken, beatings, and I knew that they were oversold and I might not be able to kind of scalp. I do that from time to time, but it's not the main strategy, right? And I could probably count on two hands the times that I've done that. You tend to make a lot of money when you do it. But at the end of the day, you usually when things are selling off, they're selling off for a good reason. You see what I mean? And so it's difficult to try to fade those moves if you're a counter trend or a person who thinks they're smarter than the crowd. Because even if it does sell off and the people are crazy or ignorant or whatever, there's no guarantee that it's going to snap back or rebound. Sometimes they keep going. So you have to design a set of rules around that. Anyway, the study was, I think it was inspired by a friend of mine. I know his brother Dan. His name is Paul Hickey. He's at Bespoke. I don't really know him all that well. I know his brother Danny pretty well. And he had talked about overnight risk, and so I had expanded on that, and I got his permission and this and that. And the idea was to compare two different types of trades. You buy and compare two columns. You can go to Yahoo Finance or wherever you get your data. It's publicly available. You need daily data, open, high, low, close. And the study and I did it on a spreadsheet. The last time I looked, it was like for 28 years. You could do it with any type of stock or instrument. I did it with mostly stocks, just again, to have a conversation about what you might feel about overnight risk. So the study was buy Friday's close, whatever amount of risk is appropriate for you. Maybe cut that in half, especially if it's new for you. And without any thought, you sell it at Monday's open. Then you repeat that. Even after you've sold Monday, you come back and you buy Monday's close and you sell Tuesday's open. You got it. Sit out the rest of the day, you buy Tuesday's close and you sell Wednesday's open. And that becomes the model. Buy the previous day's close, sell the morning of. And you complete that for as many decades as you can. Then in the next column, you say, okay, I'm going to buy Monday's open and I'm going to sell Monday's close, going to go home flat. The next day, I'm going to buy Tuesday's open and sell Tuesday's close, going to go home flat. So what you have are two columns that look at risk from an overnight over the weekend. That's column, I guess, C. Well, no, figure it out. If there's open, high, low, close. So column E would be overnight risk, overnight over the weekend. Column F would be intraday risk. Open, buy the open, sell the close. Now you could do this with short selling as well. I did it with long only. And then you compare, you scroll that down, compare those returns over that period of time. For the time that I had studied the SPY, the overnight risk paid 42 times more than what the intraday buy the open and sell the close, which again, as trading rules are kind of oversimplified, right? There's not a lot of sex appeal to that. But good trading models tend to be super simple. They don't have to be, you don't need differential equations. Now, I know people who can do differential equations in their head, and that's okay. It kind of serves them for what they do, but you don't need that. Now, you can gear down the volatility on your portfolio to where you can sleep at night. So if you might be risking a certain risk unit during the day, doing what you're doing right now, or at least that's what you're trying to do with kind of mixed results, cut it by 90% and try what it feels like overnight just to see, because the numbers didn't lie. Now, you could make the argument, but yes, Mike, I can find patterns during the day. I know that. But how much time do you have to spend? because it doesn't take me any thought whatsoever to buy a call option on the SPY or the QQQ for that matter. And I'm not saying you'll have to figure out what trading strategies are appropriate for you for a compliance and in a financial planning standpoint. And they always say, do this, for compliance purposes. You have to figure out if this is appropriate for you. I'm just talking about an academic study looking at spreadsheet data so that you can see the data for yourself because it's publicly available. I can't massage the data or I can't draw conclusions that aren't supported by the data. And I think if I remember, because I'm busy with other stuff, right? I'm busy succeeding, I'm winning. So I looked at, for whatever reason, 93, like January something of 93, up until like maybe 2021. So it was a long period of time that I looked at the data because I wanted to see 9/11. I wanted to see the subprime morass of 07, 08, right? I wanted to see that. You can probably run it through COVID as well, which we did, which is why I did it through 20, right? Because COVID was around March. The epicenter when the bomb hit was like March. It started, I think, March of 2020. So through COVID, and you can look at that data just in terms of points. And when I compared the points that were made from overnight over the weekend versus the points that you made from buying the open to the close, it was 42 times greater to take the risk overnight. And again, there was no sex appeal to it, but you freed up all that time. So if you want to sit in front of the screen, you can do that. Or you can keep it simple and find a way to maybe say, okay, now I can clean and filter out that data because I didn't filter the data. I just said, no matter what happens, buy the close. I don't care the day. I don't care the day, the next day, sell the open. There was nothing about it. I didn't filter for volume. I didn't filter for trend. So you might be able to go in there and say, okay, if the SPY is above XYZ number of days moving average, then do the strategy. If it goes below that, turn the strategy off. What is that day? I don't know. It could be, 200 day is more for investors. So maybe start with 50, then maybe try it with the 20-day EMA, exponential moving average, as a trend indicator. And say, okay, if the trend is up and the slope of the 20-day EMA is positive, right, then follow this strategy. If it's not, and or if the instrument's price trades below, right, so if the closing price of the SPY is below the 20-day EMA, then no trade. So you sidestep all the downtrend stuff. It can get a little choppy, but you might be able to filter and further clean up those ideas because over the period of the study that I did was 93 through the end of 21, because I take December off. So I have a lot of time to kind of do the stuff that I've been thinking about that I just don't have the time to do. So I just sit around and fire up a hooter and no, I don't fire up a hooter. Sit and study some data because I like to discover stuff, right? Because some of the best trading ideas are right under everybody's noses. You just have to know where to look and think about that insight. So if you're having trouble, again, this is an exercise to do if you need to see empirical data that's completely objective as to why you might have an irrational fear about holding risk overnight. Now, again, you have to figure out what leverage, if you're using leverage, is appropriate for you. I don't know what the hell that number is. Only you do. Talk with your desk manager. Talk with whatever. But this is a simple study that you can do to look at the data. And then you could say, okay, I don't want to have to memorize stuff because then the more I get into memorization, to me, when I think of memorizing stuff, is like, is this a bullish pair? Is this a bullish flag pattern? I don't know. Look at that wick. The damn wick screws up everything. Damn it. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.